Despite headwinds from the UAW strike in September and October, shares of automaker Stellantis have rallied more than 40% over the past 6 months, trading just above $26 a share today. One analyst, though, downgrading the stock, calling it fairly valued after that massive run-up and then fairly valued at the current level. We want to bring in the analyst behind that call, Daniel Roeska. He is the senior analyst at Bernstein. Daniel, it's good to have you here. So we've seen a big run-up in the stock despite some of the headwinds and challenges facing Stellantis. You're saying it's currently it's valued, fair valued around its current levels here. What do you need to see, or are there any catalysts on the horizon that you see potentially really changing the narratives surrounding Stellantis?
Yeah, I think the up and downside is fairly clear right now, right? 24 is going to be a tough year for all of autos, but especially Stellantis, right? They are seeing very high inventories in the US that will push discounts up. The order books in Europe, their second largest market, are also kind of running out, which will push up discounts, and that will take earnings down, probably EBIT margins down 240 basis points year on year. The upside clearly is that this is a great company, right? They restructured after merging between Fiat Chrysler and Peugeot, and they really did a good job of setting this up for future success. Looking towards their 2030 targets, 300 billion in revenues, about 7% EPS growth until then. That's not, they don't have to shy away. But right now in this moment, the next couple of months will be dominated kind of by more headwinds. The next catalyst will be the Capital Markets Day in June. Mid-June, they have a Capital Markets Day up in Auburn Hills, and we'll lay out the strategy to the end of the decade. And I think that will give investors and probably analysts a little bit more confidence again. You
mentioned those Dare Forward 2030 targets, and you even mentioned in your note and just now, ambitious but not unrealistic, especially with that 6.8% revenue compound annual growth rate. How much of you think that strategy is factoring in a major or significant improvement versus the environments that we have right now for car purchases?
Well, that's a great question. I think the difficulty always is right now, car makers are earning as much as they ever had. And so there'll be competing factors, right? We will see a market normalization. Consumers can look forward to cheaper cars again. And at the same time, of course, the companies like Stellantis will not stand still, right? They will work on the costs. They will bring down costs on the platforms. They will introduce software-driven revenues. So I think it's a give and take. But what you need to believe for Stellantis to get to those targets is that they can maintain double-digit EBIT margins. And the car industry in the past has not been the best steward. I think this is a company that has the ability to do that.
Daniel, when it comes to how Stellantis stacks up against some of its peers, yes, it has exposure to the higher end of the business, also has exposure to more of those mass market vehicles. How are they positioned relative to some of Europe's other larger automakers?
I think it's a really interesting company because you have three big parts, right? You've got the US with the trucks and large pickups and SUVs. That's really more like a premium company. In Europe, these are small cars, mass market cars, $30,000, $35,000. They compete with the Opels and the Volkswagens of the world. They're really at the lower end of European mass market. And the risk here is that Chinese competitors pushing into Europe will lower margins for everybody, and also Stellantis in the sector. And the third bit, which is growing, is their business everywhere else, but not in China. So the Brazils and Mexicos and Zimbabwe's and South Koreas of the world, that's a really strong suit. They're one of the few OEMs really focused on what they call the third engine. And using that, we think the third engine growth will offset some of the weakness in Europe in the years to come.
While we've got you, Daniel, also want to talk Mercedes-Benz here, specifically on this kind of luxury end of the auto industry here. You likely see, after this week Q1, likely seeing negative volume growth, bottom of the range margins as supply issues persist. How well positioned is Mercedes to get past some of those supply issues relative to the rest of the industry?
I think they're about the same as everybody else. What Mercedes and BMW and Porsche, maybe to lump the three big European premiums together, are facing is suppliers want more money. Volumes are sluggish, and 24 will be a difficult year. What Mercedes is doing differently, though, from BMW and Porsche is that they're pushing up their vehicle in the mix. So basically, The C-Class will be a bit larger, the E-Class will be a bit larger, the S-Class will be a bit larger, making the cars more expensive and more profitable. And that's the magic, in a way, behind the premiumization within Mercedes over the next couple of years.
I'm just trying to get back into my CLA from 2014 that my dad made me sell, Daniel, when I moved to New York. I got hit with the fresh MTA pass once I got up here. Appreciate the time. Daniel Roeska, thanks.
Thanks.